In this video, I want to talk about 3 undervalued stocks in March 2025. Let me tell you right away the stocks, the companies. You have Amazon in 1, Gravity in 2, and Alimentation Couche-Tard in 3. In case this is interesting to you, you can stay and welcome to this video. The first company I want to talk about is Amazon, right? You all know Amazon. This is a market cap of $2 trillion, and now the stock is declining. You have a current drawdown of 50% below high. That means that you have a lot of uncertainties, and a lot of uncertainties with their capex, with their margin improvement in the future, and the global volatility, the tariffs, etc. It leads to a lot of doubts when it comes to Amazon. But I think the doubts are unjustified. I think Amazon, with the rate at which AI is improving, robots are improving, I think Amazon will benefit immensely from the improvements of the world. Like in the coming decades, I think this is great. The way I see Amazon is, look at this. Let me show you what I see. You get a beautiful business that has been increasing the revenue for decades at a very healthy pace. And now it seems like the most profitable businesses, the most profitable segments in Amazon are growing faster. And because they will grow into bigger segments, these profitable segments will improve the total profitability of the group. And when I mean different segments, maybe I can have access to this one on Guru Focus. You have, where is it? Let me check really quick. You have different segments when you talk about Amazon. You have the logistics parts, you have AWS that is growing at a very healthy pace, you have the Amazon Prime service, you have the Prime recurring business, you have the digital marketing, and Amazon WS is growing really fast, like 20%, 30% per year. Okay, this has a tremendously high margin. AWS is an amazing company on its own, and because AWS will grow into a bigger share of the pie, AWS will lift the overall margins for Amazon. The same thing is true for their segment about digital advertising. This is a very high margin business. This is one of the top 3 leader in the digital advertising industry with Google and Facebook, and this is what will lift the margins. So you have an overall international logistics business for Amazon that is not very profitable, that will not grow much, and you have these 2 key segments growing very fast, very profitable. And now you see the growth in net income. Here is what you see in green here. I'm expecting a lot more growth when it comes to profitability, net income in the future because of these 2 key segments. The company does not have a debt issue. They produce strange free cash flow because they reinvest a lot in the business. Now you may be aware of the big capex increase they planned for 2025. If you increase the reinvestments, the big capex, it will be a drag to free cash flow. But this is normal. Amazon is used to big reinvestment processes. They have a 7-year reinvestment phase. Jeff Bezos is back into working with the company. So I don't really worry about the culture of efficiency, reinvestment opportunity, 7 years cycle for this business. So you have some dilutions here and there. You have some debt here and there, but these are not red flags. What really matters for Amazon is the growth in revenue, the growth in profits in the future. They want to be like a huge octopus and be everywhere. And for the moment, they are doing it. They are succeeding in their culture, in their vision for the world. And with the advent of AI, they have clearly said that AI will be implemented in every part of Amazon. And when Jeff Bezos is saying this, you can believe what he's saying, and because we already saw that already. Similarly, the second key point, if you look at the long-term picture, is robots. robotics that will be implemented and maybe will replace the workforce for Amazon to a certain extent. Nobody knows the reality of this one, but that's a call option on robotics, and people are sleeping on this one. There is a lot of manpower for Amazon, but in the coming years, I wouldn't be surprised if more and more robots are implemented in this process in Amazon to not replace the manpower, because manpower will be shifted to other jobs, but will replace the hardest task, the manual labor for Amazon. And you have a lot of manual labor when you talk about Amazon. So if you look at the margins for this business, the margins are net margin of 10% right now. Not that great, but they plan on improving because of these two segments. And if you look at the PE ratio for this year, you have a PE ratio of 32. So you are talking about a profitable business that is growing at a double-digit rate. The leader is in his category, that is investing massively in the future with big capex at a PE ratio of 30-35. If they continue like this to grow 10-20%, it will be a PE ratio of 25. And that's the lowest valuation Amazon has ever had in their existence, because in the past the company was not really profitable, like real bottom line profits, gap net income. But seems like this is changing, and now Amazon is becoming increasingly profitable. And for that reason, I think the stock is not crazy cheap, but I think that's a good deal if you want to invest in Amazon. I think that's a good moment. Or for sure it can drop a little bit. It can drop for a while. Obviously, we've seen this in the past. But if it drops by 20% again from now, the stock will be absolutely cheap in my opinion. And I will double down on this stock. So just for the sake of disclosure, I own Amazon, and I think I will double down on Amazon if it drops, because the tailwinds are extremely good for this company in the very long term. The management is great, the culture is great, and the price is okay for Amazon. I'm speaking because the PE ratio of 30 is not in an absolute basis cheap, but for Amazon, for the quality of the business, for the runway of the operations, for the margin improvement potential, I think is great. And if you look at the metrics for AWS, everything is improving. If you look at the revenue growth rate, everything is improving. So maybe you can expect a strong rebound for the fundamentals of the company for the remaining of 2025.
By the way, if you're looking for a complete framework to analyze stocks and build a strong portfolio, I have a coaching program. More on that at the end of the video.
The second company I'd like to focus on is Gravity. Maybe you are not aware of what Gravity is. That's a company in Korea that is developing mobile games. So in the past, this company was not profitable. Look at this. This is the net income. You see some red. And then in 2016-17, they shifted from desktop games to mobile games. And now you can buy in-app items. So the games are the same. It's just that they shifted the platform and now going into mobile, and you can buy stuff inside the mobile games. And it's a very profitable business. So now they are quite profitable. They produce some strong free cash flow. This is a company in Korea, so they don't do dividends, they don't do buybacks, and they don't have any debt. The market cap is low. You have a market cap of $390 million. Okay, remember this. $390 million of market cap. Now let me look at the latest data on a quarterly basis about the cash they have on the balance sheet. The cash on the balance sheet is $390 million. Can you spot what is wrong about this business? The business is selling at cash. They reported the earnings a few days ago, a few weeks ago. So the cash balance is in line with this. The net income is dropping a little bit, but they are still continuing to produce cash. Maybe the growth rate is decelerating, so the company is selling at a discount, like the stock is dropping, but still you have an amazing balance sheet. And if you look at the stock price now, this is the past 10 years. It's a 27x or something like this in the past 10 years. If you had invested in this business a few years ago, you would have been very happy. And you have a lot of fluctuations because it's all about releases of new games. If their games are good and they have a lot of traffic, or if their games are bad and a complete flop. So you have a lot of volatility. But at the end of the day, my opinion is the cash pile on the balance sheet acts as a cushion, like as a minimal threshold. You can't go below, because in the past, let me check annually. In the past, every time since the company was profitable since 2017, every time the company dropped at cash level, it rebounded. You never had a moment when the company was trading below cash. And just to save you some hours of analysis, this was not always true. Before, when the company was not profitable, you can check 2009, 2014, it happened that the company dropped below cash. The market cap was below cash, but the company at the time was unprofitable and they had some difficulties with management. So this is not the goal of this video, but they had the difficulties were in the past, and now it's not happening again. The company is now profitable every quarter. They don't have difficulties with management. And every time since 2017, the company was at cash level, it rebounded sharply. So now maybe this time will be different, maybe not. But the company, you get a company for free, selling at cash. And this is a company in Korea. So I don't expect any dividends. I don't expect any buybacks. This is the way it works in Korea. They are very different compared to US companies when it comes to capital allocation. They just plan to have a lot of cash and use some of the cash to reinvest in R&D to make new games. So don't expect any dividends, don't expect any buybacks. Full disclosure, I own Gravity. So if it drops, I will be happy and maybe buy more. If it goes up, I will be happy. That's fine. And the stock is declining. I bought the stock around $60, a little bit less than this. And I bought the stock a few months ago. And the stock has declined recently. Now on a year-to-date performance, it's minus 12% for no reason. I mean, the earnings are okay. The cash balance is increasing. It's just that the world is moving. And now you have Asian indices that are dropping because of tariffs, because of a few earnings of other companies. So this is a side effect, external shocks that are impacting the stock price of Gravity, but Gravity is doing well. Gravity has a lot of cash. And Gravity, just if you want to get more information about this one, Gravity is owned by Gung Ho Entertainment. This is a Japanese company. This Japanese company owns 60% of Gravity. It's a large owner. It has been the case for 15 years, okay? And Gung Ho Entertainment just got an activist. So the Japanese activism and Gung Ho Entertainment now is having more dividends and more buybacks. Let me check. Gung Ho Entertainment, in case, well, in this video you have 4 stocks for the price of 3, right? Gung Ho Online Entertainment, market cap of $1 billion and enterprise value of $400 million because the company is profitable, not growing that much actually for the revenue. Look at this. Net income is positive, they have a lot of cash, and they do some buybacks. Like in 2024, this Japanese company bought 7% of their shares, and they got a new activist that will boost the buybacks, that will boost the dividend payment. Dividend yield is 2%, it will increase in the future. So maybe if you buy Gravity, you have a call option on a potential second order effect of the activism from Gung Ho that holds 60% of this one. So maybe you can have a second order effect that will move the capital allocation policy for Gravity. I wouldn't bet on this, to be honest. So I don't have this in my investment thesis. If it happens, that's great news. That means Gravity will use all this cash to do some buybacks or dividends. But frankly, the probability is quite low. So the thesis for Gravity is quite simple. They make profitable games, mobile games, not only in Korea or in a few countries in Asia also. And by the way, it's also their games are also available in the Western world, so you can download them in the store. And that's it. The company is selling at cash, and you just wait for a catalyst, wait for a new game that will increase the stock price like it had in 2020 or a little bit before. Great game in 2019, a great game in 2017. You just wait for a catalyst, and you wait for a potential call option of their mother company, Gung Ho Entertainment, that may change the capital allocation policy for this one. Very simple investment thesis. It's a value play. I don't know if that's a net what you can call it, but a company selling at a very, very cheap price and a PE ratio of 6. So if you look at the enterprise value by the free cash flow, you have 0.05. Price to free cash flow of 4. Like, the company is still profitable, generating some strong free cash flow and and selling at cash. I don't know what you want more. This is maybe the easiest investment opportunity you can find. You have to be very patient because the stock price can be volatile for a while, maybe for 1 year, 2 years, for some reason. But I think the cash pile will be a threshold that the company can get below. We will see. Wait and see. I'm a shareholder, so I will be impacted if this drops. And the third stock I will talk about in this video is Alimentation Couche-Tard. This is a company that operates a network of convenience stores in Canada and in the US, and also in Europe. They bought out some Total Energy gas station in Europe. So that's why the company generates income through the sale of tobacco products, grocery, beverages at the gas station. Basically, they don't make much money on the gas station, but if you buy some snacks when you fuel the tank, they get more money. And the company is having some bad times at the moment. You have a lot of uncertainty because of an acquisition that is failing. For the past 6 months, Alimentation Couche-Tard has been trying to acquire 7&I, which is a Japanese company. And this Japanese company is refusing the acquisition, saying no, and they don't want to make an aggressive takeover, but the Japanese family is refusing. There is a change in director for 7&I. That's a mess, and this uncertainty with the acquisition is causing the stock price to drop alongside the market. You get my point. But investors don't know if this acquisition will work out or not. And this is the biggest acquisition that Alimentation Couche-Tard has ever done. This is why it's a big deal. It's not a small acquisition. We are talking about acquisition of $40 billion, $50 billion. In this article, can I have this? I'm not sure. Let me check really quick. Oh, here it is. $47 billion takeover offer. So Alimentation Couche-Tard is a company in Canada. The market cap is $46 billion. It's the same size as this company. So they will double their operations. They have done some operations like this in the past, but not that big. Alimentation Couche-Tard has a history of doing acquisitions with debt and then deleveraging, and then a new acquisition with debt and then deleveraging. So it's not the first time, but it's very big, it's massive. The company is generating more revenue, the net income is going up and to the right, the free cash flow is going up and to the right. They do some buybacks, like over the past few years, they bought back 3% of their shares, 4% of their shares, 5% of their shares, 2% of their shares. That's fine. Okay, that's not excellent, but you are happy to see this. And do they have a dividend yield? Yes, 1% dividend yield. So 1% dividend yield, you get a 2 or 3% buyback yield for a company that is profitable, big, in expansion mode, having some debt, but that's in the spirit of the company, so that's not a main issue, and available at a P ratio of 15. So a lot of the worries are discounted. P ratio of 15, and you have a lot of uncertainties when it comes to this big Japanese acquisition. And since the acquisition, since the announcement of the acquisition, the stock has gone sideways. So we will see. Maybe the stock will go back up if the company rejects the acquisitions, because that's a risk. I mean, making an acquisition of a company that doesn't want to be acquired is a risk. You will have conflicts with management, you will have conflicts with employees. This is not the goal. You want to win-win for everybody, right? And despite the negotiations, Seven and I, they don't want to be acquired. So it's a tricky situation. Maybe in the coming months, we will have a piece of news saying that Alimentation Couche-Tard is giving up on this acquisition. If they give up on this big acquisition, I'm expecting the stock price to go up, because the uncertainty, the wall of worry will decline. The uncertainty will decline massively. And still, people will remember that that is a company that is profitable, growing, available at a PE ratio of 15. So it's a very simple business model. The only thing that will impact the stock price is the acquisition, if it turns out to be good or bad, rejected or accepted. That's a lot of uncertainty, not a risk, because the vision of Alimentation Couche-Tard is great, the management is great. It's just a lot of uncertainty that is creating this opportunity at the moment. So that's it for this video, guys. You have Amazon, Gravity, and Alimentation Couche-Tard.
If you like this content, I have an investing coaching program. In this program, you will learn a complete investing process. You will learn how to find good stock ideas, how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio. Additionally, you will have access to my personalized guidance for long-term results. We will do weekly calls where we analyze stocks together, and you will have access to my private number available 24/7 for full support. If you are blocked, if you have any questions, I'm here to help. Click the first link in the description to get more information. You will get a video that explains how everything works completely for free. No need to sign up, no need for your email address. Just click the first link in the description and I'll see you on the other side.